Hey traders, Jason from Levitt Brothers. So in this video, I'm going to talk about the current state of the market. I'm going to show a long-term S&P monthly chart, and then I'm going to show some shorter-term indicators. So you could say this is more like the state of the shorter term, because most of the stuff I'm going to show you is shorter term. Maybe in another video this week I'll do longer term. We'll see. But just want to look at the current state of the market. You know what it's done recently. January was great. February was weak. Starting to bounce now in March. I want to see what the indicators are saying, see if they support this bounce, yes or no. All right, so let's get into it. All right, so first of all, long-term monthly chart with Bollinger Bands. You could see that the index tends to, in a trend, the index will tend to ride its upper Bollinger Band and then dip either to the middle band or to the bottom band. So we have end of 2018 bear market, then we have a recovery to the top of the top band, a test of the middle band, and then ride it up again. We had the COVID sell-off where the bands just didn't really come into play, or I don't think you could expect them to come into play because of what was going on. But then we got back to work and we rode the upper band up, as you can see. So now we have a trip down to, we've had multiple trips between the lower band and the middle band over the last 10 months. But overall, I mean, you pretty much, anyone who has a strong opinion about the market, I would show them this and just kind of remind them that the market for the last 10 months has been mostly range bound, moves up and down, no staying power, lots of alternating months. You see, right here and here we have 2 down months in a row, and then right here and here we have 2 up months in a row, but otherwise it's just alternated up month, down month, up month, down month. So I would say overall I would call the market neutral, no strong bias. To get really bearish, to get really bullish here, I think we need to, let's get rid of those. I think we first need to get above 4,100 here. That's a key level. And then we got to get into the upper portion of the Bollinger Bands. And if I draw a trend line in here, of course, we could at any time just go down and revisit that lower band. So right now, long term, I say market is neutral. S&P is unchanged going back 10 months. Over the last 10 months, lots of overlapping candles, no progress in either direction. Anyone who says the market is definitely strong or definitely weak on a longer term basis, well, that's not what the monthly chart tells me. All right, let's drill down and look at some shorter term indicators. All right, so here's the S&P 500 up top, the 5-day moving average of the NYSE AD line, advanced decline line down below. Positive and negative divergences call many turns. They aren't perfect. When you get a divergence, you tend to either get a pause or an outright reversal. Okay, so for example, if I look over here in July, we had a S&P here, and then S&P moved up to here, and then when it moved up, actually let me delete those, start over. So we had S&P here, and the 80 line print was there, and then the S&P moved up to there, and we had a negative divergence there. And what happened is we moved sideways for a week, and moving sideways for a week gave the indicator enough time to rotate down and then curl back up, and then it resumed its uptrend. So that's one of the possibilities, that when you get a divergence, you simply get enough sideways movement to allow the indicator to rotate to the other side, and then it curls back up and you can resume the trend. The second, the alternative consequence is you have, in this case, we had negative divergence here, between this high, lower high here, and then we got an outright reversal, as you can see. So when you get a divergence, you don't want to ignore it, because you're probably going to get a flat period at best, followed by a continuation of the trend, or at worst, you're going to get an outright reversal. And in either case, you should be playing really good defense. Okay, so if I zoom into today, not today, but like over the last couple of weeks, we had a positive divergence. As the market was moving down in February, it fell, the 80 line fell hard at the beginning of the month. We put in a lower or a higher low there, and then just even last week when we had this last final push to a new low, we had a significantly higher low there. So it told you that even as the market was moving down, decliners were losing control, advancers were beating decliners, so advanced decline line was moving up. So even though the market was moving down, we were given a subtle hint that the the selling pressure was starting to fall off and advancers were starting to take control. So a reversal was probably going to happen. That's what's happened so far. Last Thursday we had a gap down reversal day. Friday follow through. Today basically a flat day. Okay, so short-term bias is to the upside now, coming off of this divergence. Now, same chart with the Nasdaq. This is. I got the wrong chart here, so we'll skip this one. All right, so here is the SP 500 versus the breadth thrust indicator. One of my favorite indicators. Divergences call lots of turning points. Breadth thrust is 21-day moving, or the 10 moving average, 10 EMA of the total of advancing volume versus total volume. And you can see, you can pause the video and you can scan your eyes from left to right. You can see divergences call a lot of turning points. And like I said in the last chart, even like when you get a divergence, like say right here, which happened right here. In this case, we moved sideways, okay? But then we got another divergence and we actually got a dip. So when you get a divergence, you either get sideways movement and then a continuation, or you get an outright reversal. And in either case, you got to play good defense. So looking at last week, that last grind down where it's just like pushing lower, pushing lower, pushing lower pretty much day after day. But look at this, the breadth thrust was steadily trending up, okay? So that was a sign that the bears were losing control and they weren't going to be able to completely push things. The market wasn't going to completely fall apart. So the bulls were starting to take control. So we're likely to get a reversal, which is what has happened so far. So near term bias to the upside. All right, next chart. This is 5-day highs. Okay, so very simple. We're going to look at, in this chart, we use barchart.com data. We're just taking all the stocks in the market. We're seeing how many stocks print a 5-day high. Pretty simple indicator. And what we're looking for non-confirmation on the way up, and we're looking for like reversals on the way down. So for example, over here where the market was, 3 stabs up, it tried to go up there, and pretty much got close there. We had a lot of stocks printing new highs, a 5-day high there. We had very few stocks printing 5-day highs there. And then even as the markets tried to move up, now that technically it's not a divergence because this made a lower low right here, but still this is so close to the high, and look how many fewer stocks are making a 5-day high. So that told you that there was this last little thrust up right here had very little support. So it was most likely going to roll over and fall, and that's exactly what happened in February. All right, so then if we fast forward to today, we have over here, market going down, but look, towards the end of the month, beginning of March, you had an increasing number of stocks making a 5-day high. So even though the market over here was falling, you had the number of stocks above a 5-day high printing a 5-day high went from like 500 up to like 1,100. So that's like more than double the amount of stocks were making a 5-day high. So that told you that even though the index was moving down, beneath the surface there were a lot of stocks that were actually moving up. So that told you that a reversal was probably coming. The opposite of this is 5-day lows, which we use very similarly. If the market's going to be moving down, you'd expect, in order to confirm that move down, you'd expect more and more stocks to be printing new lows. And when that doesn't happen, it tells you we're going to probably get a reversal. So when the market was dropped to there, we had this many new lows, almost 3,000. When the market dropped there, a lower low, we again had almost 3,000 stocks make a new low, a new 5-day low. And then again, when the market dropped to another lower low, look at that. Now we only have like 2,000 stocks. So between those last two drops, like right here, the market leg down, made a lower low, but we went from like almost 3,000 5-day low, stocks, almost 3,000 stocks dropped to a 5-day low to like less than 2,000. So a lot less. So a lot of stocks resisted falling, and that told us upside pressure was starting to build and we were going to get a reversal, and that's exactly what happened. All right, so now we have two more charts here. So this is the S&P 500 up top. Down below is the Russell 3000 stocks above a 5-day moving average. You guys know the routine here. We're just looking beneath the surface to see how many stocks are participating, if you get expansion, if you get contraction, to see if certain moves have support or if they don't have support. If they have support, then we're probably going to get a continuation. If we don't have support, we're going to get at the very least, we're going to get sideways movement and possibly a reversal eventually if it continues to act that way. So in this case, market was moving down, down, down. Number of stocks above their 5-day moving average was actually increasing. Over here, this is like 15%, and this is 40%. So even though the market was dropping, you had more and more stocks that were trading above their 5-day moving average. It told you that beneath the surface, upside pressure was building. All right, last chart, S&P 500 versus 10-year rates, okay? The market still does not like high rates, okay? So rates moved up here, and the market dropped. Rates moved up here, and the market dropped. Rates just moved up here for just like 2 weeks, and the market dropped. And now rates have been moving up since early February, and what's happened? The market has dropped. So if the market is going to rally here, so it bottomed, reversal of candle last Thursday, follow through Friday, tried to follow through today, basically closed flat. If the market is going to rally, we're going to need to see rates go down. Otherwise, it's going to be one of two things going to happen. Either the market's not going to be able to rally, or the inverse correlation between these two is no longer going to exist. All right. So longer term, as I said, via the S&P 500 monthly chart, I think we're neutral. Lots of overlapping candles, no ability to sustain a move in either direction. Market is unchanged going back like 10 months. In the near term, lots of positive divergences with breadth point towards higher prices in the near term. But when we get good stats on the 5-day moving average, the 5-day highs and such, we need the baton to hand off to the 10-day, to the 20-day, okay? So it's great. Those 5 days called a nice reversal. We've gotten some decent moves, but now we need stocks at printing 20-day highs, stocks above their 20-day moving average. We need those stocks, we need those indicators to also improve. All right, so overall neutral, near-term bias to the upside, but it's not a strong bias yet. All right, we'll see you next time.